On Monday, the markets gave the first sign of hope that we are ready to bounce back from what has been a pretty extended one-way fall. But by the end of the day, a lot of that hope was lost. Now, all this is also happening ahead of the elections. Maharashtra, UP, and all these numbers will start coming out in the next couple of days. And that will also have some kind of a rub-off on the market if the state elections have slightly different results than the central elections, and if some favoritism goes back towards the government that is already at the center. Having said that, markets have not really been falling because of politics alone. There's a lot more happening out there. We peaked out at the end of September or early October and have been falling ever since. This has also come on the back of what has been one of the poorest earnings seasons and also a one-way rally in the dollar. In fact, we can see the dollar and the Nifty turned around at exactly the same time. The dollar index started to go up and the Nifty started to go down. And this is where we had sort of discounted the rate cuts in the short term. So there was an oversold condition. There was a case for the dollar to rally, but I only thought it was going to be counter trend in nature, which means maybe retrace 50-60% of the last leg. Now we have gone past the high of the last leg, which means we've retraced more than 100%. So that sort of changes the entire picture as far as the dollar index is concerned and puts me on a back foot on the whole thesis that the dollar is in a bear market. I mean, I thought so in 2016-17. It worked well because there are a lot of gyrations and it led to a good commodity rally, especially in gold. And once again this year, the sell-off in the dollar from the peak led gold to new highs. But that was not accompanied by new highs in oil, copper, aluminium, and so on, which is what you would have normally expected. And so this has resulted in a massive divergence even within the commodities basket or commodities segment. And we have a very, very different situation overall going on over there. So while we can go into the micro of, what's happening in one commodity versus the other, but overall the commodity cycle in terms of the third wave has not played out. And as long as the dollar is rising, we are still in a second wave correction for the commodity stocks. That's one part of the story. And the rising dollar typically is your risk-off indicator, and that sort of played out this time. Some of it has also been correlated with Donald Trump coming to power and therefore his measures that would strengthen the dollar and so on. So there's so many different factors we are associating to the same one for putting us in the condition that we are. But coming completely domestic, if I look at what is happening in the Indian market, so here it goes. We've actually entered one of the poorest earnings seasons since the last couple of years. And I started to think about this. We've developed strikes so that you can actually see historical earnings. You can see the cycle. You can see the growth rate. You can compare it with the price. So you have to look under two different segments. If you only want to look at the valuation charts, you go under fundamental valuation. But if you actually want to look at the price of the underlying stock and the valuation together on the same chart, then you go to charts and then choose strike valuation setup. So that gives you the RMI, momentum indicator, the valuation history, and the price all on the same chart. And if you press max, you see the maximum history that is available as of now, which is from 2012. And in some cases like Reliance, it's also there till 2005. And we'll backdate all of the stocks all the way to 2002 eventually, once we are done with some of the cleanup work we are doing on the database. So you should be able to see a lot of changes and new features come in only after that, after we go into real-time prices, with a 1 minute snapshot data from NSE in the coming month. But the main point being, when we created that, the idea is that you can see price and valuation. And when you can see that historically, and I like to then change it to a weekly chart so that I can see some of the shorter term gyrations as well. But having done that, in the months of, April, May, June, I started to look for charts that were showing a good case for the markets going higher, for certain stocks going higher, because we've been hearing about overvaluation for quite some time. And that was the case. And last year we had super high earnings growth, like Nifty growing at 30% and so on. And then this year the earnings growth started to slow down and the PE ratios have already dropped. So it was very interesting. Do we think that the PE ratios are high or low? Well, if they have dropped from peak 28 for Nifty to 21, it looks like, okay, we are in mid-range, not very high, not very low, but we are somewhere. Maybe is it fair value? And the same thing was also visible on a lot of stocks. So when I went and looked at Maruti and I saw that the prices have not moved up that much and valuations have come down, I thought there was a good case in certain stocks like that. And so I started to explore the idea and found many others that fit that case, whether it's Ashok Leyland, whether it's Shriram Finance, and so on. Now, these ideas did actually play out. Over the last couple of months, these stocks all went on to new all-time highs. But the interesting part is that the new all-time highs in the Nifty or in these stocks was not accompanied by new highs in valuation charts, okay, which means valuations didn't move up that much, even though earnings is growing in some of the cases. In other cases, like the Nifty, the earnings is actually flattening out and not growing. So we have this unusual situation where new highs in prices are not accompanied by new highs in valuation. And then you start wondering now, especially in hindsight, that markets are falling. Was that a negative divergence? Was that a sign that things were not as good as they appear? Now, if I purely go by Nifty, it looks like, because earnings have actually dropped to zero from what was 30% a year back. Zero may be an exaggeration. Even if we are at 8% or 9% for the Nifty basket, it's a pretty low earnings reading and a significant decline from 30%, which is what the markets were probably anticipating. That is why they were not giving higher valuations. I mean, if you were growing at 30% clip, why would your valuations drop below 25? They're already at 28. You would remain the 28, 25 range and keep going higher in the market. But that is not what the market was doing. The market was actually giving up valuations, not moving up as fast as growth was taking place earlier, because somewhere the market started to anticipate that probably that was the last round of growth. But we still continue to see growth in certain sectors, certain segments like financials. Many financials continue to show growth and their valuations have been falling. And so we started feeling that yes, financials are the most undervalued segment of the market. So probably just like PSUs were undervalued a year back, maybe money goes into financials and they do well. So that was a good theory on table, and it has actually not yet broken trend. So we can still say it's a theory live and happening. But I'm starting to wonder that is this also a sign of peak cycle? So I don't know that yet. I don't know the answer. This is the first time we're exploring data from this angle. But we are beginning to see it, right? We saw it in so many stocks that made new highs and then have given up a lot of those gains. Now, of course, they've not gone back to the starting point, but they've retraced significantly. And so you wonder whether that was the case, right? Was it really a fall signal? Or is it something else? Why haven't markets picked up as much as growth? So was it a sign that growth is finally peaked and turning around, and it's going to take some time for growth to come back, which is what I am hearing. Slowly by slowly, people are beginning to say, not this quarter, maybe the next, and maybe the next to next. And so if you don't have good growth numbers all the way to March of this year, then how can the markets go up? And so all of a sudden, our headlines are now traced up with different ministers. And I was like, even where I was at the CNBC event last week, and now the FM is quoted in the newspaper saying that we need lower rates for the industry. And on the other hand, you have the RBI, which has been saying that it's too early to cut rates because inflation is still up, and especially food inflation has been sticky. Though they are saying that inflation will cool off a bit into Jan and Feb once the base effects roll over. So the recent spikes in inflation data only base effects. But will the rollover inflation be sufficient for the RBI to start cutting? Now, some of us can argue yes, because real interest rates are pretty high, so there is room for them to cut. But for some reason, they've been backing off. I don't know whether it's the stock market that was worrying them overheated. But I would say there's another one, that's the currency itself, right? We started this whole discussion with the dollar. The dollar's been rising. The dollar's at the peak. And if the dollar index is rising and USD-INR is also at a near all-time high, if you start cutting rates aggressively, you're only going to unleash more fire on the USD-INR, right? The rupee will continue to decline because of lowering rates. So that's a very thin line that the RBI has to balance between so many different factors. It's not just about inflation, but it's also about your currency, which has an indirect impact on inflation and can indirectly impact your imports, exports, and so on. And therefore, the RBI cannot overdo it on that front also. So many things for it to think about. I don't know what they will do in the next meeting, which is coming up in the first week of December. I, of course, being a market participant, would have wanted for quite some time, when I was bullish, for them to cut rates. But I wonder the way it's going, that if they're cutting rates into what is already a slowdown, will the first 25 basis points cut really make that much of a difference that growth has already slowed? So, of course, you can buy up stocks on the hope that, finally we are into that cycle and things should improve. But the longer you wait, the more difficult it becomes that the first 25 basis points will have any impact. We've seen that in US cycles, 2000, 2008, that, multiple rate cuts had to take place. In fact, even India, 2015, it took multiple rate cuts before the next upcycle really started. So it's not going to be a straight line. Can we really expect that moment the RBI announces rate cuts, now the markets go into a flurry on the upside, just like they did for the US markets in September? And now the answers become a little more difficult. Okay. But yeah, you might get some run up on that into the year end or something like that. Maybe if they do listen to what the government is saying and various, pressure points for moving in the direction of lower rates. You have seen that happen around the world. If everybody is cutting rates, why not me? But again, USD INR is near the lowest range. Do we want to do it right now, or do we want to wait a bit? So catch 22, and it depends, because you have high real interest rates. There is room for RBI to do some signaling, and ease that pressure. So it may even happen. But does it really turn around earnings? And if earnings don't turn around, is it really good news for the stock market? And it doesn't sound so good right now unless we get further signs. I mean, I was even hoping that, yeah, a lot of the government spending that didn't happen in the first half of the year because of the elections would cook up all together in the second half, and that could also be sort of a trigger for markets. But the way they've been falling pretty much one way has sort of taken that hope out of the expectations to some extent. I still don't know. If the market does have that kind of strength, then we should see it tomorrow once the election results start coming out, if we have really discounted most of the negative. The fear now is that US markets that were running up on these expectations, both from Trump and rate cuts, have started to roll over a bit. And if their earnings trajectory starts to weaken, we're going to be hearing about Nvidia's earnings later tonight. And if they start reacting to the negative effects of the Trump actions, which are going to be counter global trade, if you start going up with tariffs and various other measures, even though tax breaks can be good, but tariffs can actually hurt world growth. And if markets start pricing that in, because most US companies are also globally exposed, you cannot just have a win-lose kind of a situation where you win and everyone else loses. And if you are going to not do win-win, that means you're going to end up in a lose-lose situation. So I don't know if that's the case. And problem is, we won't know till Jan or Feb, once Donald Trump actually comes in, starts taking action, and you start seeing measures on the floor. Till that point of time, uncertainty rules, and markets don't like uncertainty. So we are still in an uncertain world. What can happen short term is, if you do get extremely oversold, you can get a bounce back. Will the election results provide the ammunition sufficient for that kind of a bounce, or will it be countered by US markets overnight selling off? That we will only know early in the morning, because I'm recording this late night on a holiday, which was for elections on the 20th of November. But I've sort of given you a highlight of what to think about. If you want levels, I've spoken about them in my recent updates, and today morning also on my YouTube short. It's 23,750. That's the line we were trying to defend. We failed to cross above that, and we saw the sell-off on Monday. We'll be watching tomorrow whether we are able to get back above that and generate enough momentum on the upside. If not, the downside momentum continues. That is the very, very short explanation I can give of where we are, because we've been falling for more than a month. And are we going to continue in that direction will depend a lot on our ability to really do this very short-term turnaround. And if we are not able to, and if the election pop is not sufficient to hold out, then we'll probably see selling pressure resume, and things continue to extend on the downside. And so that is what you need to be prepared for. And risk is not completely gone. All we are trying to do is navigate the short-term swings of the market, overbought to oversold. But uncertainty will continue to keep a lot of volatility in the market, and downside risks open till probably Jan, Feb, where we get a better understanding of what Donald Trump's policies are going to be. So that's this highlight. I think main thing I wanted to discuss, and one very important one from the angle of using strike valuation history, is just like every technician understands negative divergences with momentum indicators, I consider historical valuation charts as sentiment indicators, and the same applies there on a long-term basis, that you can get negative divergences with Nifty on valuation charts, where new high in Nifty is not confirmed by new high in valuation, or new high in valuation is not confirmed by new high in Nifty. And those can actually be signs of turnaround, weakness, something that the market doesn't believe in. Because if the market believed in the growth cycle, then why wouldn't it give you higher valuations for higher growth? Now suddenly, if it's not giving you higher valuations for the growth that you're getting, it actually believes that the growth does not exist, or it is in the late stages or turning around. We've already seen that at a index level. We may not have seen it across all stocks, But that was the worry, and market seems to be giving into that worry as of now, that the growth cycle has started to weaken. And the next 6 months are going to really be about being able to determine whether that growth cycle can turn and whether the RBI can provide enough ammunition for that to happen. So that's all on this quick update just before markets open tomorrow. You'll hear this first on SoundCloud, and hopefully later tomorrow you can catch us on YouTube. In the meantime, do subscribe to IndiaCharts Insiders Club if you want my daily market updates, and start using Strike. For all the tools and features, start using Strike on a regular basis. It has so much data that gets updated every day that can help you in tracking markets, understanding, taking decisions, and planning your course, especially in times of volatility. Thank you.